Canada and the US are making major moves that are shaking up trade between the two nations. Recently, Ontario canceled its contract with Starlink and banned American companies from bidding on government contracts. This decision signals a strong stand by Canada, showing they won't let the US have free rein in their market. At the same time, LCBO, the world's largest liquor store, stopped importing American alcohol right when new US tariffs began. This sudden change hit American producers hard, causing them to lose $1 billion in one day. Canada didn't stop there. They slapped a 25% tariff on $155 billion worth of US goods, with $30 billion of that going into effect immediately. This measure affects a wide range of products, from farm goods and cars to household appliances. It's like adding extra fees to many items, making them cost more for buyers on both sides of the border. Ontario's leader, Doug Ford, even warned that if the US continues with its policies, Ontario might cut off electricity exports to the US. This statement is a clear signal that Canada is ready to use its resources to stand up for its interests. These actions are putting US businesses under pressure. They now face tough choices: absorb the losses or push for changes in US policy. On the other side, many Canadians are choosing to support local products, strengthening their domestic economy. The trade tension doesn't stop with goods and services. The US has also imposed tariffs on Canadian natural gas, adding about 10% to its price in the US market. This move comes as the European Union struggles with soaring gas prices, over 100% higher than before, and unstable supplies. With its abundant natural gas reserves, Canada now stands out as a reliable partner for countries in need of energy. A key project in this shift is the LNG Canada initiative, a major investment expected to deliver up to 14 million tons of natural gas each year once it's fully operational. This project highlights Canada's growing importance in the global energy market. Canada is gearing up to make a big splash in the global LNG, liquefied natural gas market, a move that could create thousands of jobs and boost the country's role in supplying energy worldwide. Thanks to its prime location, Canada can easily ship LNG across the Atlantic to Europe and through the Pacific to Asia. This smart setup gives Canada several shipping routes, which means it isn't stuck with just one path. Meanwhile, the US is starting to feel the heat from both Canada and Mexico. Once a leader in the LNG market with massive production and a huge export network, the US is now facing challenges. Changes in policies and new tariffs have made US LNG about 15% less competitive in some key markets. Canada is seizing the moment to step up its game, and Mexico is also investing heavily to expand its LNG capacity by over 20% in the near future. This competition is driving everyone to improve, finding ways to lower shipping costs, enhance technology, and offer better deals. In the long run, these efforts are reshaping the LNG market and pushing countries to adopt smarter, more flexible strategies for energy production. On a related note, tensions between the US and Canada have also been brewing over trade issues. When President Trump slapped a 25% tariff on Canadian steel and aluminum, it rattled Canadian industries and strained the long-standing relationship between the two neighbors. Trump's harsh remarks about Canada's independence even stirred up strong feelings among Canadians, who took these comments as a direct challenge to their national pride. In a bold show of solidarity, many Canadians launched a boycott against American products and even US tourism. Stores, supermarkets, and local businesses began favoring Canadian-made goods, and families started rethinking trips to the US. This grassroots movement is not just a reaction, it's a clear stand for national values and a refusal to be bullied by policies that many see as disrespectful. The boycott has already made a noticeable impact. American states that count Canadian tourists among their top visitors, like Florida, Texas, and New York, are feeling the pinch. A small drop in Canadian tourism could cost jobs and lead to billions in lost revenue for the US. Even American brands, from famous bourbons to everyday items, are taking a hit as Canadians turn their loyalty toward homegrown products. Canada's boycott has grown into a powerful display of unity and a fight for national pride. Every time controversial comments are made by US leaders, Canadians double down on their commitment to protect their values. This movement isn't just about avoiding American products. It's about standing up to policies that seem to ignore Canada's independence. Across the country, people are showing their support in everyday ways. Shoppers are filling their carts with locally made items, and many are even canceling vacations to the US. The empty supermarket shelves and quiet tourist spots are clear signs that Canadians are united in their resolve. They are sending a strong message. Canada will never back down to pressure from a larger neighbor. But the drama isn't limited to consumer choices. In a surprising twist, Canada has proposed a 100% tariff on Tesla vehicles, a move that could reshape the North American auto scene. Tesla, a leader in electric cars and a symbol of American innovation, currently dominates about 70% of the US electric vehicle market. With a 100% tariff, the price of a Tesla Model 3, usually around $40,000, could double to $80,000. This would make it far too expensive for many buyers, pushing them toward other brands, including those from Europe. This bold proposal comes at a time when Canada and the US have long enjoyed a robust trade relationship, exchanging around $50 billion annually in cars and essential metals like aluminum and steel. However, recent protectionist policies have put Canada in a difficult spot, prompting it to take drastic steps to safeguard its industries. The impact of such a move would stretch far beyond Tesla. It could shake up the entire auto industry, affecting major American companies like General Motors, Ford, and Chrysler, and even disrupting the plans of smaller manufacturers. With over 2 million cars produced in Canada every year for export to the US, a tariff crisis could lead to factory shutdowns and significant job losses. The Canadian auto sector alone is worth about $50 billion each year, so any disruption could hurt the whole North American economy. This trade conflict isn't just a battle over tariffs or corporate profits. It's about preserving national sovereignty and respect. Every choice a Canadian makes at the store or every trip canceled is a stand for independence and a refusal to let larger political forces dictate their future. The stakes are high, and the effects are already rippling through the economy. Earlier in February 2025, the Trump administration increased tariffs on Chinese goods by 20%, further intensifying these tensions. As the US and Canada continue to clash over trade policies, the world is watching. This isn't just a local dispute. It's a turning point that could reshape global markets and even influence the pace of the green energy revolution. China has decided to change its shopping list. Instead of buying as much as it used to from the US, it's now turning to Canada and Europe for its supplies. This shift means that American farmers and businesses are losing out on billions of dollars, while Canada and Europe are benefiting big time. For a long time, the US was a major supplier of oil and natural gas to China. But in March 2025, after the US added extra fees on Canadian oil, China quickly found a new source in Canada. With an upgraded pipeline that can now move almost 3 times as much oil each day, Canada has become a reliable and cost-effective partner for China. It doesn't stop with oil. China is also buying more liquefied natural gas, LNG, from Canada. A huge project known as LNG Canada is set to begin operations in 2025. It's expected to export a massive amount of LNG each year, gradually taking business away from the US. The change is making a big difference in agriculture too. In the past, China bought a lot of soybeans, wheat, corn, and cotton from the US. Now, countries like Brazil, Argentina, Spain, and the Netherlands are stepping in. American farmers are left with too much produce, lower prices, and shrinking profits. Even US tech companies feel the impact. As China strengthens its trade ties with Canada and Europe, big names in technology are losing their market share in China. The big question now is whether this move by China was a mistake by the US or a part of a larger plan. What's clear is that as long as the US continues to impose high fees, it risks pushing its trading partners even further away. China's new alliances could reshape global trade for many years to come. In short, this isn't just about a trade disagreement, it's about a major shift in who holds the power in global commerce. As Canada and Europe step in to fill the gap, the US finds itself in a tough spot. trying to catch up in a rapidly changing world. Thanks for watching. Please do not forget to subscribe and activate the notification bell.